Welcome to today's ETF.com webinar on the regulatory outlook for ETFs. I'm your host, Sumit Roy, Senior Analyst here at ETF.com. Thanks so much for taking time out of your busy schedules to join us. We really appreciate it. So, with the new SEC Commissioner stepping in and evolving policies around ETF structures, crypto products, and operational reform, there's a lot going on in the ETF regulatory landscape right now. We're going to dig into all of it, everything from ETF share classes and EDGAR Next to the potential for new asset classes like private credit and crypto to enter the ETF space. Joining me today are three fantastic guests, each bringing a different lens to these topics. We have Carolyn McPhillips, who is the president of MFDF, where she supports independent fund directors on governance and regulatory issues. We also have David Rosenfeld, who is Director of Operations at Quality EDGAR Solutions and a leading expert in SEC filings and operational compliance. And last but not least, we have Kevin Gustafson, who is partner at K&L Gates and has helped guide fund sponsors through ETF strategy, structure, and regulation globally. Carolyn, David, Kevin, thanks so much for joining me.
Thanks for having me.
Yeah, thanks for having us.
Appreciate it. Absolutely. So before we get into the discussion, why don't I have each of you kind of give us a brief introduction and, give a little bit of background about what you do so the audience has some context before we get into the discussion. Carolyn, why don't we start with you, then David and Kevin, you can follow suit.
Great, thank you so much. I'm Carolyn McPhillips. As Sumit said, I'm president of the MFDF. I am a recovering lawyer. I started as a 40 Act lawyer eons ago. But for those of you who aren't familiar, the MFDF is an independent association for the directors of mutual funds, ETFs, closed-end funds, and other registered investment companies. So we help directors navigate the evolving regulatory environment and steward shareholder investments on behalf of their shareholders. I've been with the MFDF for a really long time, and I have seen a huge evolution in the industry. And I think one of the biggest ones is the explosive growth of ETFs, especially in the last few years. So it's been a really interesting time to be a fund director and involved with the fund director community.
David, why don't we have you go next?
Yeah, sure. My name's David Rosenfeld. I'm the Director of Operations and one of the founders of Quality EDGAR Solutions. QES is a regulatory filing firm. We build a lot of different technology products that assist a broad range of 40 Act firms, service providers, fund administrators in meeting the ever expanding SEC filing and EDGAR mandates. We've been in business for almost 20 years now, and I'm very excited to be here and to talk to everyone about a lot of the different regulatory changes and mandates that we can expect in the coming year.
Awesome. And Kevin?
Thank you, Sumit. And again, thank you for the opportunity to join this panel and this discussion. As you mentioned, I'm a partner in the law firm of K&L Gates. I'm based here in Chicago. Just more recently joined the law firm about a little over a year ago. And prior to that, had about 2 decades as a general counsel and CCO for several fund complexes, including some of the earlier stage ETF firms in the space. So that doesn't mean that I'm old. That just simply means I started working when I was 13. But again, this is a great conversation to be part of, and certainly something that's important given the mandates and all the moving and transitions here in the regulatory framework.
Absolutely. I'm really looking forward to this discussion. And I want to start with the big picture here. We have this new administration and new SEC leadership. Kevin, I'll start with you. What kind of tone or policy direction are you expecting from the new commissioner when it comes to ETF regulation?
Yes, and that's important because what's going to be supporting that industry and what's going to allow it to continue to grow, it's very critical to see what the regulator is both doing in real time as well as where it's going. So out of the box, what we've seen in the first few months is as expected, which is there is a definite shift in tone from the regulator. There has been a new chair that's been announced and is going through the process of approval even as we speak. But with that, we've already started to see the administration and its influence around particular topics where they've come out and they've actually given either direction or encourage either the acting chair or others in staff, so that there are key places in the industry, and certainly those that impact ETFs, where we're seeing that shift that again goes to elements with regards to the climate rule, ESG, shareholder activism, proxy voting. Those are all things that are expected and were expected with regards to the shift in priorities. We're also seeing that there is a highlighting of getting access to capital markets, both private and public. That's going to be reflected in a lot of the initiatives for the new administration and the new chair. And then with that too, we're also seeing a priority for certain types of asset classes. And again, you mentioned private credit, you've mentioned digital assets as well. That kind of innovation and structuring, I think, is going to continue to happen with the new administration. And then lastly, I think we're anticipating that with so much of the structural changes and staffing turnover and changes we're seeing with the SEC, that too might influence not just ETFs, but certainly broadly across the industry. And so those also are places where we're watching and hoping to see if there's going to be a positive impact, negative impact, or just simply, let's say, a delay in approvals or a delay in certain priorities. But again, I think that this is a both tone, substance, and structure across the SEC will absolutely be impacting and framing a lot of what ETFs will be doing and where they'll be going in the next year to several years.
So Carolyn, you work very closely with fund boards and directors. What are they expecting? Are they bracing for a lot more oversight or added responsibilities?
I think it's an interesting question because, as Kevin laid out, there's a lot of areas where we are expecting sort of specific deregulation. So we're going to see sort of the throttling back on ESG rules, for example. However, as the SEC looks at capital formation and really makes that sort of the key part of their mission that they're focused on by expanding access to asset classes, I'm not sure that directors are really going to see sort of less expectations from the regulator. And I think that's true for a couple of reasons in this context. So as the regulator adapts to allow more products and different types of structures, particularly those that give rise to potential conflicts. So, we're going to talk later about the ETF share class, for example. They're going to look for someone to fill that regulatory void. And who's going to fill the void that's not filled by a rulemaking? It's going to be the fund board, because they are there to police conflicts in the fund industry. So I think they're going to see that as an additional responsibility. When we're talking about more volatile asset classes, more complicated assets, that's going to require more board time because they're going to have to get educated on these new asset classes. And so I think that's going to take more board oversight. And then when we're talking about expanding these assets to retail investors, those investors need protection. And if it's not through a regulatory structure from the SEC, fund boards are the ones who are there to be flexible and to address the needs of their particular funds and the shareholders in the funds that they oversee. And so I think boards, while I think people are applauding the deregulatory period that we're getting ready to enter, or that we all anticipate is going to happen, I do think fund boards should not expect a real lessening of what their responsibilities are going to look like in this new SEC. They're just going to look different.
So David, you are very intimately aware of the operational side of things. How do you see the current regulatory climate affecting operations for ETF sponsors?
Well, the current regulatory climate has significantly increased operational complexity for ETFs. I mean, particularly, and really the 40 Act space in general, particularly, regarding SEC regulations and EDGAR filing requirements. Over the past year alone, we've seen substantial regulatory shifts, most notably the rollout of tailored shareholder reports, the mandated transition of Schedules 13G and 13D into structured XML, the forthcoming amendments to import reporting, the form show, although it was recently, delayed. I think that's a particular importance to the ETF space, and preparations for EDGAR next. These developments underscore the critical need for robust data aggregation solutions. As the universe of structured XML continues to expand, sponsors must adopt sophisticated data management strategies to efficiently fulfill these evolving regulatory mandates. I'm optimistic about the SEC's current direction and new leadership. At the recent ICI Investment Management Conference, Interim Chair Ueda emphasized a collaborative and logical approach to regulation. Particularly, he highlighted a number of things, but some things that jumped out to me was the possibility of scaled requirements in certain ways based on fund size. Recognizing that the regulatory burdens for ETFs with over $1 billion in assets under management can differ significantly from smaller emerging ETFs that that could positively impact the sponsors, especially considering, today's robust pace of ETF launches. Additionally, he seemed willing to revisit and reassess the practical impacts of upcoming endpoint amendments. To me, that indicates kind of a thoughtful, pragmatic regulatory strategy moving forward.
That's great. Great color there. I want to now dive into specific topics, and one that's top of mind for a lot of people is ETF share classes. I know, Carolyn, you mentioned this just a minute ago, and we've seen many sponsors try to get this off the ground. Dimensional updated its filing recently. A lot of issuers are rumored to be trying to do the same thing, and there's growing anticipation about the SEC greenlighting this structure for more firms. Carolyn, you've been watching the ETF share class discussion very closely. Where do you think the SEC is headed on allowing firms beyond Vanguard to launch them?
I mean, I think it's interesting because I can't think of many examples where we have one firm in an industry that's able to offer a particular product strategy or particular product wrapper in this case. And I think this current SEC is going to be uncomfortable with the anti-competitive nature of what that feels like when there's only one, especially when we have about 50 other fund complexes that want to have this ability. So I think that will be helpful with a more sort of competitive-minded SEC coming into it. I'm also going to quote Acting Chairman Ueda's speech, where he talked specifically about these share class applications at the ICI Investment Management Conference. He noted that the first ones were submitted almost 2 years ago now when the Vanguard patent expired. And there's been no action in those 2 years since. So he stated that he has directed the commission staff to prioritize their careful review of the many applications filed for this relief. The director of the Division of Investment Management has also been clear in her public remarks that this is a clear division priority of looking through these applications. And as you mentioned, Sumit, the updated application from DFA and likely others reflect some conversations likely with the SEC staff, which should signal some movement on the final approval of these share classes. So I do think we'll get an ETF share class this year from the SEC. I mean, whether, Kevin, I think is going to talk about the operational hurdles that will remain even once the applications are approved. But I do think that we're going to see that within the year. I think the other option that I've heard people talk about a little bit is whether the SEC would do a rule rather than exemptive relief. I think that's unlikely right now for a lot of reasons. Kevin mentioned sort of the reduced SEC staff. A rule takes a lot of manpower and time. And I think they're anxious to get at least the first sort of tranche of these share class applications out the door. And the application process is really more flexible. They can go on a case-by-case basis. They can approve it, and then they have a little laboratory to see how it's working and determine, whether, when, and whether and how to offer it on a more broad basis, sort of like they did with the ETF rule originally. And so that's sort of what I anticipate.
Great. So yeah, Kevin, what kind of hurdles still remain? And you talk to fund sponsors. What kind of sense of urgency do they have right now as we get closer to this potentially happening?
Yeah, and Carolyn raised a lot of really good points around this. Is that going back to early 2023, these applications started to trickle in, and then there's been a surge. And again, I believe the number is approximately 55 applications have been filed. And to a certain extent, there had been this long quiet period. Then again, with the new administration, with the announcements both David and Carolyn had noted, there has been this activity on the ground, and there have been updated and amended applications that have gone in with much more detailed and prescriptive framing of what's going to happen if, let's say, there were an application adopted and approved. Here's the kind of reporting regime might be implemented. And again, this is meant to be somewhat of an indicator about the staff's viewpoint, but we're expecting that this is something that, as they say, with each application, iterative, starting to test drive a little bit about what this might look like. So with it, just very quickly, what is in the application and the amended applications and what we've seen, and maybe what's not. So from a regulatory perspective, the applications have really been focusing on this notion of a conflict of interest or a difference in treatment between two share classes on the same fund. And the SEC has been focused on that and wants to kind of dive in and say, well, how do we protect one side of the house versus the other? if one's going to be very beneficial in this instance versus that instance, and having that somewhat laid out and having it made transparent. And as Carolyn said, kind of pushing to the board to be monitoring and reviewing that process. The regulatory framework for all of that is, in essence, between the four corners of what's called Rule 18F3, which is, in essence, the determination of share classes. This is happening all the time from fund boards with regards to mutual funds. But now it's going to be this added element and dimension. And so now we're starting to see, well, some of the deeper factors, these are the kinds of ways in which you might be wanting to monitor for either a mistreatment or a conflict of interest. Those things could be, how did you treat cash reserves? How did you allocate brokerage? How did you handle issues with regards to tax treatment? So those things are kind of coming forward, and boards and others are starting to consider more and more, what is that going to look like? But apart from the applications and then the compliance of that share class with Rule 6C11, there still are other elements that, of course, from a regulatory perspective, would still need to be dealt with. And I know that, again, with some of the operational issues we've mentioned, would our service providers be able to handle this tomorrow? And again, that's everything from the service providers at the major custodians or fund administrators, or even the extent to which in the ETF space, that ecosystem with regards to primary markets, authorized participants, market makers, liquidity providers, would they be able to handle that overnight? And I know, David, you've had some thoughts about that as well.
Yeah. So, I think what you said in relation to, the service providers, I think that the industry has been, very focused on this with different, applications, and, it's definitely been front and center for a lot of the different service providers across the industry, specifically the fund administration teams, broad, legal practices across the ETF and 40 Act space. I think that, the industry is going to adapt quickly. I think that, should this get approved, this is something that, I think the industry's been, looking for quite some time. So I do think that, overall, with most of these types of shifts in the market, and I think that the industry will adapt.
Kevin, you mentioned how platforms in the sell side might be nervous about this. What's the issue there, and how might they respond if ETF share classes become much more ubiquitous?
Yeah, so specific to that, to me, one of the aspects of having a share class, let's say currently on a particular platform, on a broker-dealer, a regional, a wire, wherever it's made available today, the concept is, well, with the approvals with these share classes, could be an ETF, could be exchange listed. One of the benefits of that should be it's one fund, just two different share classes, and that access should be allowed on various platforms. As a practical matter, that may not be the case, considering you access an ETF, let's say from a brokerage account. There may be other ways in which accounts that are accessing mutual fund share classes are administered differently. But apart from that, one of the things that the industry more broadly is looking at, and we've heard this again across several channels, is that under the current regulatory framework, having a side-by-side, let's say a mutual fund and then an ETF, the same sponsor with mostly the same strategy, there are challenges about having those side-by-side comparisons in, let's say, those same types of platforms, where downstream that advisor, that rep might say, well, in most instances, we'll expect the ETF to be cheaper. Would we be required, whether it's under a fiduciary duty, under, let's say, regulation best interest, Reg BI, in either of those instances, do we need to default always to the ETF? And so there has been some more recent regulatory enforcement actions from late last year, where under that particular fact pattern, a clone ETF was laid out side by side and sold side by side with a mutual fund. And in that instance, the SEC expressed that, this ETF should have basically won the coin toss in most instances, and here didn't. And so with that, I think that there's perhaps a lack of direction or clarity when you think of having the identical fund, the actual fund itself, just with two different share classes, what that might look like for comparative fee matters on the sell side downstream. And I think that, again, that might be challenging or problematic for many platforms if there isn't guidance or if there isn't an opportunity to have that clarity. And so I think that there also might be a wait and see. And that is in addition to what might be a challenge to bring an ETF share class onto a platform for, let's say, due diligence, for monitoring purposes, for what other criteria that might otherwise be put to any sponsor that would otherwise bring in a new ETF. So I think that those things will continue to be in the room, but this additional kind of referral, recommendation, or selling element downstream, I think is going to be something that'll be evaluated by many of the same platforms.
You know, when we were preparing for this webinar, someone said, was it you, Kevin, that if we start to get these share classes, the number of ETFs is just going to increase dramatically. We have something like 4,000 today. It could increase by many thousand more. Is that what we would see in this case?
Yeah, I think another way of saying that same question is, and this has been asked elsewhere, is does this mean it'll be the death of mutual funds? And I think the answer is both, really addressing both pieces of that, which is we should expect over time to see a lot more ETFs in the marketplace for a lot of reasons related to the benefits of the structure and so forth. In the opportunity of having an ETF share class, there are going to be a lot of instances, again, where that'll be very attractive, or for just the right channel, just the right strategy, that will make sense. So net, should we be seeing that increase? I would believe so. Would we see potentially a decrease in mutual funds? The answer to that is maybe, but this also, to have this opportunity, this optionality within the same fund actually may help retain some of those mutual funds as well. I think everyone is in agreement in the marketplace. There are places where a mutual fund might be the preferred vehicle. That might have to do with regards again to the investment profile, the nuances regarding the investment strategy and how the portfolio management implement that. And I think primarily the access channel. Again, when you think of retirement accounts, you think of things like practical things like fractionalized shares and so forth. There may continue to be places where that might be preferred. And so, like I said, we may numerically see that continued increase in ETFs. I don't know if we're going to see overnight. You know, Carolyn and David have both mentioned, you know, this could be happening in this year for orders to be starting to be rolling out, let's say, permitting this model. But would we start to see that within 2 weeks after that launching? I don't think so. So I don't think we're going to see, let's say, 1,000 ETFs overnight as share classes. I think both operationally, access to capital markets, the ability to kind of absorb that into the marketplace. And again, each fund sponsor deciding in which case that might make sense for them. Some of that will have to continue to kind of take a natural course. But over time, I think, again, we'll start to see that continued usage and increase with ETFs.
Yeah,
and I just want to add to the share class issue and the death of the mutual fund. I mean, there are several ETFs that have also applied for a mutual fund share class to take advantage of the retirement plan channel. So, you know, I think that's a sign that because of the issues in the retirement space in particular, that it's likely that we're going to have mutual funds around for a while until, you know, that particular issue is addressed.
Makes a lot of sense. Definitely an interesting story. Going to keep a close eye on that in the coming months. Now I want to turn to the operational side of things. David, I know you're keeping a very close eye on EDGAR Next. For those who aren't in the weeds, what is it and why does it matter for ETF issuers?
Sure. So, you know, EDGAR Next is somewhat of an overhaul of the EDGAR filing system. It officially went live on March 24th of this year, and it's designed to improve security, transparency, user control, layering individualized login.gov accounts for, you know, issuers and trusts that require multi-factor authentication. Prior to this, you know, you didn't have that layer of security when going to disseminate an SEC filing. You know, one of the key changes is that every EDGAR filer now must designate at least 2 account administrators officially to manage access, assign user roles, and annually certify that all filer account information is accurate and up to date. And those don't have to be internal team members. A lot of ETFs we work with and different you know, overarching kind of multi-series trusts are opting to maybe have their fund administrator or, you know, their law firm or their you know, EDGAR filing service provider act as a account administrator, and in kind of a level of redundancy, you know, to managing that access and making sure you always kind of have someone who has access to those accounts. You know, for ETF issuers specifically, especially those managing kind of complex structures across multiple trusts and administrators. It's not uncommon that an ETF, family, so to speak, might have series that are present on different trusts. This transition can have major implications. EDGAR Next introduces a centralized dashboard for managing user access, tracking filing activity, securely delegating authority to third-party filing agents through a formal authorization process. It gives filers much more control and oversight, but also it demands some upfront preparation to avoid filing disruptions. The SEC has set clear compliance timelines. So all filers must be fully transitioned to EDGAR Next by September 15th, 2025. That means that ETF issuers should take action now if they haven't already. So some of the key steps in taking action would be, setting up your login.gov accounts for all users who are going to need access to EDGAR, designating and training at least 2 account administrators per CIK who will manage permissions, talking to your service provider, so your legal team, your fund admin, kind of knowing, where the different ETF series sit, if they sit across multiple trusts, and knowing kind of what that interaction is going to look like in preparation for EDGAR Next, what that access level is going to look like, reviewing and cleaning up legacy EDGAR credentials. So thinking about, specifically ETFs and certain, funds that even utilize like the 33 Act regulatory model, they might have, Section 16 filers and insiders that need to file and need to manage their own code. So kind of accounting for that broad universe of filing codes and making sure that everyone's been updated and nobody slips through the cracks, and, kind of auditing for that is super important. And really establishing a plan, running trial workflows to make sure that everything's working before that September deadline, so you don't run into a problem. In practice, many ETFs that we work with, they're going to be relying heavily on their fund admin team, on their lawyers, on their EDGAR service providers to kind of run point on this. I definitely would recommend, if you haven't already, reaching out to those service providers that you rely on to just make sure that, the wheels are in motion, that the implications of the EDGAR Next transition have been contemplated, and that you're in compliance way ahead of that deadline.
It's a great rundown. Kevin, do you think there's enough awareness around all these new requirements that David outlined, particularly for the smaller issuers that might not have the same resources?
Yeah, and that's a good observation too. So one of the things that David was just describing is that in many instances, there's a lot of these nuances, new rule requirements that a lot of folks either don't pay attention to, don't see, maybe falls in the category of, oh, that sounds like plumbing, I don't have to really worry about that. But again, a lot of these will pop up in ways that always have an urgency with a deadline. And that more recently, we've seen that with amendments to the NPX filings last year, or the T+1 transition and the role of the advisor with regards to affirmations, confirmations, and so forth. You also see that with, again, the shift in direction even earlier this year with regards to Section 13 filings. And so even to have these kinds of things come through, for managers small and large, it's actually it's tough to keep track of. And then what needs to be done so that, again, both with the filing deadlines or whatever they need to be doing for filings, let's say, that gets transitioned well. One comment or one thing I think we see and observe then is that with the expansion of ETFs and the expansion of sponsors into the ETF space, is that with that, over the last several years, the expansion of service providers that helps support that and enables access to this particular area is grown with them. And so we do see, again, that allows for so many managers to come into space who couldn't build that infrastructure otherwise. And again, I think David was highlighting some of that about where, again, if you're an ETF sponsor, so many elements of these, facing the custodian, facing other service providers and administrators, distributors, all of which are there and expanding their services to support that. I think that just kind of underscores how critical that is.
Absolutely. And David, another challenge that you mentioned to me is one of siloed data. Can you kind of unpack what that looks like in practice, especially for ETF complexes juggling multiple filings?
Sure. With the SEC's ongoing modernization, we're seeing a rapidly growing universe of structured XML filings. So each of those require detailed, highly specific data across numerous reporting areas. ETF operations teams today must manage granular holdings and asset information for Nport. Sales of security data for 24F2s, proxy voting disclosures for your NPX, ownership disclosures for your 13Gs and your 13Ds, and even holdings reports for your 13F, just to name a few. And given that ETFs within a single fund family can have a wide variety of strategies and asset classes, data often resides across multiple systems. So market data providers, fund administrators, all with different books and records. The complexities of aggregating that dispersed siloed data are significant, and they're not getting any simpler. So in practice, firms are approaching these challenges in different ways. Some larger complexes have developed like their own internal manicured data lakes or centralized warehouses. Some of them are leveraging platforms like Snowflake or comprehensive compliance solutions, focusing on data like EY Comply. Others are engaging specialized service providers, such as my company, like Quality Edgar. QES, we have a dedicated data integration practice. So our approach starts with a discovery exercise, where essentially we're asking clients, if you had to manually locate this data point within your books and records, to manually input this and produce it in the structured XML, how would we do that? Where exactly would we get it from? Are there any additional validations or calculations that need to be run to produce that? And then we build out automation and code for it to ingest that data from the data point, kind of like bolt onto existing infrastructure, and ultimately output the report. Ultimately for ETF complexes, juggling multiple filings, comprehensive data aggregation and automation aren't just now beneficial, they're really becoming essential.
Fantastic. So we've talked a lot about kind of the behind the scenes ETF regulatory issues. Now I want to talk about something that's much more visible to everyone, including investors of all stripes. We've seen a wave of crypto spot ETFs approved over the past year or so. Kevin, what are the chances we see other digital assets like Solana or XRP or whatever cryptocurrency is currently popular added to the ETF structure in the near future?
Yeah, and this is a very a common question, and it's one that I think a lot of folks are tracking. With the new administration, there were a lot of declarations that there was going to be a sea change, a complete shift, and in fact that this was going to be the most crypto-friendly environment and administration that we've seen to date. And so I think we are already seeing that shift happening. Immediately prior, there was a chair at the SEC that had a very specific view and an approach, and a lot of that had to do kind of in three layers. One was a determination about whether a particular digital asset was a security or not, and a viewpoint around what that would be. I think secondarily there was an enforcement focus with regards to activities related to digital assets, like loaning or promoting or having custody related to digital assets, and in essence having that as a way to either restrict or inhibit. And then lastly, there was out of the Justice Department, there was an actual cryptocurrency and kind of enforcement initiative. I think each of these three touch points, you're seeing kind of a rolling back specific to digital assets, and some being very specific, including the recently announced dismantling of the Justice Department's crypto enforcement team. And so if one of the criticisms used to be that regulation by enforcement and litigation is not a way to actually create a workable framework, it appears as though there is a material shift that has already happened. Again, the gentleman that has been nominated to be the incoming chair of the SEC has a very crypto-friendly profile, has expressed interest and support in having a coherent and consistent approach for digital assets and how they're treated. Now, we've seen, as you mentioned, a lot of products come to market that have both indirect and direct exposures to certain underlying digital assets. And with, of course, the new president coming in and the administration coming in, we've also seen a rush and a move to put in as possible any particular coin, digital asset, token exposures, and then with it even including not just simply direct spot exposures, but even 2 times up or some kind of multi-coin exposure and so forth. And so there are a lot of exchange traded products that have been both submitted for approval. I would expect to see a continued flow of those. How those get approved and in what manner they get approved for an ETP, we'll wait to see. I think that twofold, One is that, and I know Carolyn mentioned that in this administration, there might be a lot of responsibilities that are pushed to fund boards and leave it on their shoulders to manage and navigate risks and considerations. One of the things that we've noted before is that when it comes especially to holding, let's say, a spot digital asset, is that typically those will land in not a 40 Act open-end ETF, but something that's referred to as an ETF, but is actually an exchange-traded product, and it's a trust structure. And in most of those formats, you are not seeing a fund board. And many of the restrictions or protections, quote unquote, an investor might have under the 40 Act and fund boards may not be translating into that particular traded product. So we do see that some of that will be sorted out as you go, as this continues to evolve. And then lastly, related to that as well as the extent to which, let's say you mentioned like XRP, Ripple, or Solana, as you start to, in essence, move down the leaderboard of particular tokens and what might be eligible for an investment exchange traded product. I know that some of the existing criteria that had been laid out before with regards to, is there some kind of hedge market to it, a derivative market like a futures market that's been listed to provide the marketplace the ability to arbitrage and protect? And then is there a readily identifiable way of pricing that particular token that can be used kind of independently for those that are either quoting it or validating? So I think that some of those elements specific to exchange traded products will continue to evolve as well.
So Carolyn, how are fund boards thinking about crypto as an asset class? And do you think overall it's a net benefit or a net risk for investors?
I mean, I think it's an interesting question. I think there's no question that investors are interested in this as an asset class. I think, it's sort of a couple years ago, I think the interest kind of fell off a cliff, but now in the last, 6 months or so, especially now that the SEC is giving it the attention that it is, I have noticed an uptick in investor interest. Whenever there's investor interest, that means there's going to be manager interest because they want to offer the products that the investors want to have. I think even once the custody is a big issue for these assets in registered funds, as well as the fact that the ones that are commodities rather than investments. So I think there's still some hurdles ahead for the likelihood that these will end up in investment products. However, I think if investors do want access to these kinds of asset classes, I think it is much better that they get that through a 40 Act registered product because they have the protections of the 1940 Act. So, liquidity, valuation, custody, and most importantly, from my perspective, the fund board oversight. So the fund boards are going to be there to hold managers accountable. Do you understand this asset class? How are you going to add this asset class into our fund complex in a way that makes sense based on the disclosures for our particular fund? Are you going to manage it appropriately? And then once you do get there, once you get over the hurdle for that, are they managing like they said? And is it working like the manager asserted? And so I think it's really important from an investor perspective to have some protections, and the current exchange traded products don't have those same protections. And so, hopefully with the SEC interest here, with Hester Peirce, who's the SEC commissioner, who's known as Crypto Mom, I feel like we might be able to get there in a way that makes sense. But in general, I think more choice is better for investors. I don't think we want to limit asset classes that investors can have, but I don't think we should discount the volatility and the riskiness of this particular asset class because it doesn't work in any way that we have sort of historical perspective on, how it's going to perform in the future.
That makes sense. David, what about operational readiness? Can most ETF issuers handle these assets from a compliance and filing perspective, especially as we perhaps move over to more esoteric types of crypto assets?
Yeah, I mean, I think that there are definitely going to be a lot of challenges in that. But crypto is still a relatively new asset class. Emerging technologies, evolving products, market volatility. It's going to have a lot of different compliance challenges, especially as the SEC really starts to formalize a lot of the different rules around everything. But selecting, again, I think it's so important for ETF sponsors to be selecting partners that are knowledgeable in the space and can kind of meet these mandates and help hold your hand through it. Working with a law firm that is super knowledgeable in digital assets. Working with fund administrators that have worked on these different ETFs, that have kind of been through some of the different ups and downs and ebbs and flows of the initial launches that happened last year. Working with filing agents that can and handle the rapid turnarounds and manage the fluctuations that are inherently involved in these types of ETFs. I remember I think we were involved in 3 of those initial 11 approved. I think it was 11 approved, Bitcoin ETFs, and the intensity of that race to file and achieve regulatory approval and reach the market just really emphasized to me how important you partnering with the right teams are, and making sure that you have that infrastructure set up to meet these challenges.
So we've talked about crypto, hot asset class that's entering the ETF space. Kevin, there's also been a lot of discussion about private credit, maybe even private equity entering the ETF wrapper as well. What would it take to make private credit more ETF friendly under current regulations?
Yeah, and Carolyn hit it right, which is a lot of times the products, the managers, they're chasing investor interest, right? And with every reason, the private credit space in particular, the private asset category overall, is getting a lot of increased interest and a lot of increased investing. And some of that is just the nature of the marketplace. You see companies aren't going to IPO as much as they used to be. I think the number is that over the last 30 years, the listed company marketplace has shrunk almost 50%. I think it's now down from its highs of almost 8,000 listed companies 30 years ago to around 4,300, I think is the last number I saw. And then you think, well, wait, there's over 4,000 ETFs that are listed. There may be very quickly more listed ETFs than there are listed companies in public equities. And so the diminishment of access to public equity, but also the increased usage in the marketplace and the availability around private credit, it makes sense that at some point you're looking and saying, well, how do we access that? How do we democratize it and get it into the hands of the retail investors that clearly may not have access today? And so we have seen in various stripes over the years an increase towards particular vehicles within an ETF, ways in which that access either once removed or even sometimes twice removed, trying to mimic that outcome, mimic those investments. And more recently, there have been some products, one in particular that was launched back in February, that attempted to increase that bucket around private credit. I know that specifically to private credit, the question has been asked, well, what was new or what's changed? Traditionally, all 40 Act ETFs or all 40 Act funds has a restriction that you can only have up to 15% of illiquid assets. And in that illiquid bucket, we'll call it, traditionally, private assets, private credit would have been characterized as having been in that category of illiquid based on the pricing and the availability of a redemption market for that position. This particular ETF was seeking to, in essence, recategorize certain types of private credit assets so that could be, in essence, not go against their 15% limit. And so that has been, that there's been some challenges with that. There's been maybe some market successes around that. But by and large, we're seeing that the overall challenge of having a private asset like private credit in an ETF in particular is that, as Carolyn mentioned, kind of like that best practices playlist around an ETF, which is liquidity, pricing, and transparent pricing of holdings and price, as well as the governance and some of the other elements with regards to tax. All of those things kind of make the ETF that ideal wrapper. Almost in opposite direction, having a private asset in that room is a drag against that or is pull the other direction around that. And so a lot of ways it's hard for, there's a lot of muscle strength, if you will, at either the board level or the administrator's level around how to govern that, to price it appropriately intraday for assets that aren't getting necessarily priced at all outside of your ownership of it, the ability to navigate what the marketplace is going to be doing around that private asset in terms of the authorized participants and the market makers and how that might impact spreads and price. So I think a lot of those challenges kind of remain to balance what may feel like two completely different or opposite pulling directions around that same rope.
Carolyn, you mentioned that 40 Act funds are the best vehicle for crypto. Do you feel the same way about private credit?
Absolutely, for retail investors, because I mean, there's a reason that retail investors have not historically had access to private credit, whether it's the long lockups of the assets, the volatility, the difficulty in the pricing, the complexity of the vehicles. So I think, and I think that's a real reason that if we want to provide retail investors access to these products, which I understand, Kevin mentioned the lack of firms going public now. So if we want retail investors to be able to participate in that asset increases, if we're going to give them access, it should be in a retail product, so in an ETF product, because retail investors, most of them simply don't have the financial literacy or the time to invest to really understand what these products are doing and how they work. So that's why if you come to an ETF or another registered fund product, you have a structure in place that is going to look out for your interests in a way that you don't have to. So the 1940 Act assures that the funds are diversified. They meet liquidity and valuation, to Kevin's points, standards. The assets are in custody, and most importantly, the fund boards can oversee the conflicts here, because in these products where you typically have very sophisticated institutional investors negotiating on behalf of themselves, I think you need someone there for the retail investors, and that's the fund boards and the structure of the 40 Act.
Kevin, we've seen the number of new ETFs hitting the market rise significantly over the past couple of years. And a big reason for that is the rise of derivative-based ETFs, including leverage and options-focused strategies. The previous SEC seemed fairly permissive when it came to these products, aside from maybe leverage limits. Single stock ETFs, for instance, are mostly limited to 2x. Do you see that continuing under the new leadership, or could we see a shift and how these derivatives-based strategies are regulated?
Yeah, it really would say that 2024, one of the primary stories in the ETF space was, again, a record year, both of new entrants, number of ETFs launched, and asset flows. I think the number is about 725 new ETFs that were launched in 2024, and a good percentage of those, and I believe it's somewhere over 20% of those, were actually some kind of derivatives-based outcome or derivatives-based investment profile as an ETF, again, the All 40 Act. And so with that, we've seen kind of a category really exponentially grow very quickly in the last 4 to 5 years around derivatives-based ETFs. Again, using options or using derivatives in an ETF has been around for a while. But their surge has been not just around what you mentioned, traditional leverage, almost tradable ETFs, if you will. The focus of those are primarily about trade positioning and so forth, and not really meant to be long sit and hold type investments, but really taking those derivatives that are available and actually having what has been referred to as structured outcome ETFs. And now, again, those probably break into 2 other categories. One might be those that use option structuring in a way to generate income. And then obviously kind of a larger category where options and derivatives are used for downside protection against markets that drop. And so the extent to which that those types of ETFs have grown really from a very, very small category to something that's almost $70 billion in a 4-year window, I think is a testament, first of all, to the fact that by and large, a structured outcome ETF can work. It can work we'll call it within the 40 Act and also within the actual market. One question that's been raised about this, I think you maybe mentioned earlier, is like, well, why options and why is that more popular? And again, some of that has to do with both the adoption of the derivatives rule back so a few years ago, and also the fact that in most of these instances where you look at these products, what they're holding are listed options. Sometimes they're referred to as flex options that provide a level of transparency and public pricing that's available, and also reduces counterparty risk to the point where these are listed and cleared options. So again, some of those protections that Carolyn and others are mentioning find themselves in these structured outcome ETFs. Again, if you look at the last several days, again, you'll see that what was not in the news was an options-based ETF blowing up that provided downside protection, but you're actually showing how that can work and support the marketplace. So if you're asking me both from a regulatory perspective and from a market perspective, I would agree with some of the commentators that you'll probably continue to see a growth of variations of these types of products that utilize options, especially for protection and structured outcomes. And then also with that, I think you'll also start to see continued asset flows. It's unfortunate, but a lot of times you'll see where if my neighbor's house were to burn down by a fire, is the thing that motivates me to go actually buy life insurance or house insurance or whatever. And I think in a lot of instances, watching the drawdown on equity values over the last several days motivates some folks, maybe even some that have lost money, to say, wow, I probably would have been a good investment to have moved that to something that had some downside protection. So again, I think you may see a lot more ongoing interest there.
All right, so we have just about 5 or 6 minutes left in the webinar. So I want to close with a couple of questions for the whole panel. And the first one is, what's one regulatory issue you think is flying under the radar, but is going to be really important in the coming year? Why don't we start with you, David?
Sure. I'd mentioned it earlier. I really think that one, requirement that's going to be super important over the next year is, the SEC's rule to require more frequent reporting of portfolio holdings. Kevin was speaking to liquidity classifications for different types of ETFs. You have to report that on your end port. And, that being mandated, traditionally, end ports already, ETFs already had to file their form end port quarterly. You had to produce them monthly, but you only were mandated to file them quarterly. And with this rule, you're going to have to file them monthly, and they're actually going to all be public. Whereas typically, each quarter, 2 of your end ports were actually not publicly disseminated, and only the final, end of quarter end port would be public. So now it just kind of puts, an increase on, potential data scrutiny and transparency, raises the bar for data quality, consistency, and timeliness. Oftentimes for a lot of fund complexes, and particularly ETFs that have, they're not only, they have derivatives, they have risk metrics, they've complex assets. Coming up with that every month, can be a challenge.
Anyone else want to tackle that one?
I just want to add that I think we generally think that deregulation means less oversight and compliance, and I don't think that's what this period of deregulation is going to show us. I think a lot of what we talked about today, these complicated assets and registered funds, the ETF share class, I think it's going to result actually in a lot more reporting requirements for advisors and fund boards. And I think it's critical that we get that right on behalf of fund shareholders.
Great. And final question, this is for the whole panel. Anyone feel free to chime in, and that is, if you were advising a new ETF issuer preparing for a 2025 launch, what's one thing that they absolutely need to know or prepare for?
Well, I'll start off if we have a moment here. And this is actually a conversation that I have very frequently with firms that are looking at launching or expanding or converting what they have on their fund complex. And it actually intersects, which I believe is going to be the headline for the next 12 months, which is going to be around the ETF share class. And in each instance, my recommendation is it's not too early to start talking and making relationships with the liquidity providers and market makers in that space. I think that there is already a challenge in the marketplace to be able to support ETFs that are in the space. And if that number were to go to 4,500 or 5,000, there's going to be, especially in a rising rate environment, it's expensive. And there aren't enough people in the room today that can actually support that capital market. And then if you say, oh, but within 12 months, we're adding in another 1,000 as ETF share classes, it's a little bit like voting in Chicago. You may want to start early and vote often. So I think this is something where, again, you want to be getting acclimated to that marketplace, finding out who might support your strategy, and really focusing on the implications of making sure that product, whether it's share class or a new ETF, is going to be well supported in the marketplace.
And I just want to extend on that a little bit and say that you should talk to your boards early and often as well, because boards want to partner with you. They want to help you get to where you want to be, whether it's a new asset class, whether it's adding an ETF share class, whether it's converting an existing mutual funds into an ETF. However, if we're talking about some of these products that are much more complex, boards need time to understand whether these new products fit within the complex, whether does it actually fit in the fund that you have, and whether and they need to get time to get up to speed to understand, all of these structural issues that Kevin has talked about in the ETF space. And so just make sure they want to help you, but they need time and education to do so.
Fantastic. Well, that brings us to the end of today's discussion. Huge thanks to Carolyn, David, and Kevin for the great insights, and to all of you for joining today and taking time out of your busy schedules to listen in. Really appreciate that. Be sure to visit ETF.com for more analysis, webinars, and updates. Until next time, take care, and thanks again for joining us.